Hello and welcome to another episode of Market Watch. My name is Vasanth Pereira. Today we are going to have a very special session on current developments in money market. To talk about that, with me in the studio today, Head of Treasury at Cargill's Bank Limited, Mr. Shashikar Ranasinghe. Welcome to the show, Shashikar.
Hello, President. Thank you.
So let me start with our discussion by having a sort of an idea on what's happening in terms of the money market liquidity right now. So what's your view, Shashikar, on that?
Market liquidity has dropped from a positive of 108 billion at the beginning of the year to about 17 billion negative yesterday.
Right.
And the government security holding of central bank has dropped from 330 billion to 230 billion. So that's a 100 billion drop.
Right.
And also the foreign holdings of government securities has dropped from 260 billion to 200 billion. So overall, it indicates that interest rates are under pressure to go up.
Right.
Also, inflation has picked up by about 2.5%, more than 2.5% in fact.
Right.
Alongside that, the treasury bill yields have also picked up by 0.5%.
Right. Essentially, you said the money market liquidity, comes under pressure right now. So, what factors drive that situation?
Mainly, the central bank has been mopping up liquidity. The surplus liquidity has been mopped up.
Okay.
And also, foreign sales of bonds and bills is also driving interest rates and the liquidity.
Yes, Ashika, now if you look at the government treasury auction, it's very interesting. If you look at the last few auctions, we have seen the rates rising. Even yesterday, we have seen around 8 basis point increase. In this context, what is the expectation? Am I correct to assume the rates may further, or the treasury bill rates may further go up? Or what would be the thinking over there?
Yes, Vasanth. We are on the same page. What I feel is treasury bill auctions and bond auctions have seen rates going up at each and every auction this year.
Yeah.
And the disparity between the primary auction and the secondary market has also been sorted out now.
Right.
Rates are at almost the same levels.
Okay.
So the FOMC is meeting on the 15th of March. The outcome of that meeting is going to be very interesting.
Right.
And they expected to hike rates by about 0.25% at least.
Okay.
And there's a 50% probability of that happening.
Okay.
It has already been factored in.
Right.
So following that, the week after, on the 24th of March,
okay,
the central bank is meeting.
Right.
The Monetary Policy Committee might hike interest rates because nothing was done after the Fed hike in December.
Right. Okay. Okay. So there would be a pressure in terms of the monetary policy point of view. And if you look at the last year also, we are seeing the contractionary policies came in terms of the monetary policy. And does it mean that will continue in the 2017 also? You said the next policy meeting is going to be quite crucial.
Yes.
So do you expect the rest of the year also there would be a sort of a tight monetary policy will prevail, Shashikar?
Absolutely, definitely. We will have to tighten policy in line with the US.
Right.
Because of our external debt situation mainly.
Right. So can you talk about the that you said the external situation?
Yes.
Any developments which are happening right now?
External debt repayments are coming up this year.
Okay.
But more than this year, it is 2019 that the central bank has indicated we will have a large payout.
Right. Okay.
And they have also indicated that they are going for some sovereign bond issues, as well as syndicated bonds.
Right. Okay. Fine. Coming back to the banking system, now within this context, the liquidity situation is bit of tight right now. So what is the impact on the banking system amidst this tight liquidity situation?
Liquidity is definitely an issue, but central bank, the window is still open for banks,
right.
SLF window,
okay,
standing lending facility window.
Right.
So banks have access to that for as long as they have treasury bills and bonds. This can be pledged and borrowed.
Right.
The only issue is now, although rates have been rising in the secondary market, PLR has not gone up.
Yeah, I noticed, because if you look at the AWPLR, still stand at 11.6%. I think which has seen a sort of reduction also on auction, or rather the week by week basis. So I'm wondering why it has been stagnant at that level rather than this rising.
Yes. I believe the banks with surpluses are lending at rather low rates.
Right.
So that is keeping the PLR down overall.
Okay, fine. So if you look at the interest rate scenario, as you said, within this context, am I correct to assume the rates are having a great amount of pressure to rise maybe around, we'll say 1 to 2%. What's your expectation on that?
Definitely. There's a lot of pressure for rates to go up.
Okay.
By how much, no one knows.
Okay.
The only issue is we'll have to have an eye on the US.
Right. So, going back to the US side, Shashika, I have heard about 3 rounds of rate hike can be expected within 2017. What is your opinion on that thing? Will it really happen, or what would be the scenario like?
Yes, possible. The US, I believe, will have to hike rates at some point because inflation is getting to such a point, almost a boiling point. They will have to hike rates, but in the local context, when they hike rates, if we don't hike, our bonds and government securities will not look as attractive to foreigners.
Right.
It will not compensate for the risk premiums.
Right. So there is imminent pressure in terms of the rate to keep at a high level. So in terms of the foreign interest in government bond, if you look at the last year, I've seen a huge outflows in terms of the foreign investments. So can we expect further outflows in this year also meets this situation, Shashika?
Cannot be ruled out.
Okay.
But having said that, if the US indicates that they are done with rate hikes, things might stabilize.
Right.
Also, if we are aggressive and start hiking rates of our own,
okay,
it might also help. And then the IMF facility is definitely going to help. The rating outlook, which was turned to stable from negative,
okay,
will help.
Right. So it's very interesting. If you look at the interest rates point of view, as you said, there would be a imperative pressure in terms of the rate to go up, both from the policy rate point of view and from the market interest rates point of view. Right. It's very interesting. Now, if we move on to the foreign exchange point of view, because I think now the rupee is hovering at around 154 against the dollar, right? So in this particular context, so what is your view on the currency? Because I expect there would be a huge pressure again from the currency point of view, but I need to have I should have your expert opinion on that.
Right. Central bank has in fact fixed the spot rate at 151.25, but the spot is hardly traded. It is either the spot next, sometimes the 2 weeks, or even the 1 month, which is the actively traded rate and used as a benchmark.
Right.
But these days, of course, we are back to cash, TOM, and spot next.
Right.
So it's a little more liquid, the short end.
Okay.
On top of that, Pasindu, we are also expecting the sovereign bond and the syndicated loan to go through.
Right. So that means you expected on the sovereign bond to be issued by the central bank.
Yes,
okay.
It was approved by cabinet.
Oh, fine. How soon it will happen, Shashika?
Timelines have not been specified.
Okay.
But, the amounts will be around 1.5 billion.
1.5 billion. Right. Okay.
Yes, and another 1 billion syndicated loan.
Okay.
And on top of that, if we go for samurai bonds or even panda bonds,
okay,
things might improve further.
From a currency point of view.
Correct.
But if you look at now, we are talking about the interest rate rising from the US side,
yes,
and in this particular context, our cost of borrowing in terms of the sovereign bond, I think may be at a very high level. So what's your opinion on that?
I think we are going in at the right time.
Okay.
Just before an aggressive US rate hike, and also when our outlook was revised to stable, probably is the right time to go and get these sovereign bonds.
Right.
The other thing is, if we go for samurai and panda bonds, if we can get them at the right levels, probably the interest cost will be low.
Okay.
Also, we might have exchange gains. That's if you pitch it right.
Right.
We buy the yen at a high level, and the yen devalues against the dollar.
Okay.
There might be a saving for the country, but if it goes the other way, there can be losses as well.
Right. Okay. And it's very interesting. Can you just explain us, for the benefit of our viewers, what is this panda bond?
Panda bond is a Chinese yuan denominated bond.
Okay.
So we'll be raising money in yuan.
Right.
Again, exchange rate is also an issue.
Okay. Yes.
On top of the interest rate, that is.
Fine. And I like to know about what is the sort of a intervention, I would say, from the central bank side for the forex market. Still, can we see some heavy intervention? Because I noticed in last 3-4 months also a huge pressure in terms of the foreign reserves, right? And again, IMF also came up with the issue that government is still heavily intervening. Not the government really, central bank has been intervening in the forex market. Still, can we see this that particular momentum? Still, can we see?
Central bank has been guiding the market with a reference rate for spot.
Okay.
That's what they believe the spot rate should be, and the market has been on their own. The demand and supply has been driving rates.
Right.
That trend should continue, possibly.
Right. That means, as you said, when the some of the other sovereign bond come into play, there would be a huge strength in terms of the foreign reserves may comes in, right? So up until that time, there would be a pressure in terms of the foreign reserves as well, just because of defending the currency, right? Okay, fine. So from a exchange rate point of view, Shashika, what is the expectation for 2017? Because we noticed the last year also quite a significant depreciation around, I think, if I'm not mistaken, 5%.
Correct.
Right? So what is the expectation for the currency in 2017?
There will be significant pressure for the rupee to depreciate.
Okay.
On top of that, if we get these bonds right, and the sovereign bonds and the syndicated loans go through on time, the pressure will ease off quite a bit.
Right, okay. So if we can take the rates up, I think that will put a cushion to the government or the foreign holding in the government bonds as well. So that will that help to stabilize the exchange rate? What's your opinion?
Yeah, on one hand, if interest rates are high now,
okay,
it might make our bonds attractive to the foreigner.
Fine.
If we delay it, they'll start exiting more and more.
Right.
That will create pressure on the interest rates as well as exchange rates.
Okay.
But hiking rates now has other impacts as well. It may have a knock-on effect on the other industries.
Yes.
That will have to be taken into consideration.
Yeah.
In the long run, we may have to look at other means of sorting out our balance of payments issues.
Right.
So far, it has been a positive because of remittances and the tourism income. But the trade is a concern. The trade balance is a concern. In the long run, we may have to look at FDIs.
Right.
Definitely.
Okay.
Rather than depending on debt.
Yes.
Because the idea is to pass on the risk to the investor rather than to the borrower.
Yeah. Right. Yeah. In conclusion, Shashika, what is the message that you can pass into our money market investors?
External markets are going to be very volatile.
Mm-hmm.
Have an eye on them, but no market is a watertight compartment. So have an eye on the US interest rates, the liquidity locally, Treasury bond yields, bill yields,
right,
the government holdings of securities and the exchange rate, and also the foreign holdings of securities.
Right. Yeah, actually our key takeaways today, I think there would be a huge pressure for the interest rates, right? And again, there would be a pressure to the exchange rate as well. So within this context, sort of a short to medium term volatility in terms of the macroeconomy can be seen. That will definitely, that will be backed by, or I would say, going hand in hand with the US interest rate cycle, right? So I think that pressure will have a sort of a ripple effect on the local market as well. So that's our key takeaways today, Shashika. Yes. Thank you very much, Shashika, for being with us. It's very informative, and thank you so much for coming in.
Thank you.
So thank you very much, our viewers at home. So see you next time with Market Watch.